I've really been enjoying these last few days with Tim Cestnick. He is the author of this terrific book, 101 Tax Secrets for Canadians, Smart Strategies that can save you thousands. He's also the president and CEO of the Water Street Group Incorporated. He also is a chartered accountant, and he's a terrific communicator. Tim, you've been giving us pillars for tax planning. Before we get into the pillar today, which is dividing, for those who maybe even with the very clear communication you're giving us, still a little bit intimidated by this whole concept, there's value, is there not, in just passing this on to an accountant or to a professional to help you with these things? You know,
there are some people who love doing these things themselves, and I wouldn't suggest that you have to go get a professional involved unless your situation's complex. If you have self-employment income, or you have different kinds of deductions that you're not used to claiming, limited partnership losses and things like that, you may want to get a tax professional involved, even if you enjoy doing this kind of thing yourself. If, on the other hand, this stuff intimidates you, then you probably should get somebody else involved. A tax preparer with significant experience, could be an accountant by designation, or just someone who has a lot of years of experience, is not a bad idea. If for no other reason, to make sure you're claiming everything you should be or you're entitled to claim. Because, you know, Jim, people often ask me, why are you teaching people how to take money from the government? Isn't it biblical to give money to the government? But the truth of the matter is, or isn't that important? The truth of the matter is, yes, we should be giving to the government what belongs to the government, no question about it. But the problem with most of us is that we give more than we are required to. And by hiring a good tax preparer or professional, they can help you make sure that you're minimizing what you should be paying. Yeah, so this is that fine line, or not so much a fine line, but this gap between tax evasion and tax avoidance. And what you're saying is tax avoidance is the prudent thing to do. Tax avoidance is fine because the government has said you're entitled to set up your affairs to pay the least amount of tax you're required under the law. That's allowed, but people just don't understand what that looks like. Right. Now let's talk about the next pillar of tax planning. Dividing. Dividing. What's that? Dividing income is sometimes called income splitting. It's the idea of moving income or dividing income amongst different family members so that it's not just one person in the family paying the tax bill. And when you do that, you save tax as a family, because every Canadian is entitled to a basic personal exemption of almost it's over $10,000 this year. So you're wasting that exemption if you don't have $10,000 of income. So you might as well have $10,000 at least of income. So to move it around, the income around makes good sense. Now, it's not always easy to move income around, but we can do it in a couple different ways. And I talked about this in our first show. One of the ways you can do that is through pension income splitting. So if you have an employer's pension plan that you're part of and you're collecting benefits, you can actually transfer up to half of your pension to your spouse's tax return. You get a tax deduction for that. Your spouse reports the income. It's a pretty obvious and simple way to split income or divide income. Another way to do this, if you're a senior and you're collecting Canada Pension Plan benefits, CPP benefits, you can actually arrange with the government to have up to half of those benefits taxed on your spouse's tax return instead of yours, which is going to save tax again. In a perfect world, you want both spouses to have equal incomes. That's in a perfect world. Then you're minimizing the amount of tax you're paying as a couple or as a family. Other ways that this can be done, and there's an opportunity today like we haven't seen in many months or years gone past, and that is to actually lend money to your spouse for the purpose of splitting income. Now, just to give you an example, if I were to take a number, $10,000, and lend it to my wife, and she invested that money, any income she earns on that $10,000 is going to be taxed in my hands, not hers, because we have something called the attribution rules in our tax law. Well, we can get around those rules legally without a problem by me lending her the $10,000 and charging her a rate of interest on that. And today, the rate of interest is just 1%. It's never been lower than that. And the nice thing is I can lock in that rate forever if I lend her $10,000 in this quarter. So that only gives us a little bit of time left to do this, but you could set it up. And then she's allowed to pay all the tax now on any income she earns. So that's another way to split income. Another way to do this, pay your kids a salary or wages out of your small self-employment. We talked about that in the last day. Self-employment brings all kinds of advantages, including the ability to pay your kids something for helping, and that moves income into their hands. And if they have very little other income, they're not likely to pay any tax on that, but you get a tax deduction for it. So it's a splitting of income again, and it's just another way that self-employment brings an opportunity to save tax. So today we talked about dividing. Yesterday we talked about Deducting.
Deducting. What are we going to talk about tomorrow?
Deferring.
Deferring. Okay. Now, Tim Cestnick is the expert. I certainly am not, but this is absolutely fascinating.